Imagine waking up one morning and finding out that the markets lost tens of billions overnight, not because of a surprise recession or a natural disaster, but because the government simply didn't open. That's exactly what happened during the Trump administration's government shutdowns, and the numbers, staggering stocks plunged, bonds wavered, and investors around the world felt the ripple. But why did a political standoff trigger such a violent reaction in the financial markets? That's what we're about to unpack. Government shutdowns sound abstract. They might even feel like something happening in Washington that doesn't touch your bank account. But history tells us otherwise. Every shutdown, even a partial one, creates a chain reaction across the economy. Federal employees don't get paid, contractors pause operations, government services halt, and markets, which thrive on certainty, start to wobble. Let's start with the basics. A government shutdown occurs when Congress fails to pass funding bills to keep the federal government running. During Trump's tenure, there were several high-profile shutdowns, the most notable being the 35-day closure from late 2018 to early 2019, the longest in U.S. history. That one alone affected roughly 800,000 federal workers. Many went without paychecks, some were furloughed. Others worked without immediate compensation. Businesses dependent on government contracts or consumer spending from federal employees took hits too. Now imagine this scenario through the lens of financial markets. Wall Street reacts to uncertainty, not just raw data. When hundreds of thousands of workers suddenly have less money to spend, consumer confidence dips, retailers, small businesses, and even tech giants feel the pinch. Stock prices begin to wobble. Analysts start revising earnings estimates downward. And the media? They amplify the uncertainty, feeding into investor anxiety. During the 2018 to 2019 shutdown, the stock market wasn't immune. Major indices like the S&P 500 and Dow Jones Industrial Average experienced sharp swings. Investors began pricing in potential economic slowdown. Analysts at top financial firms estimated that the shutdown cost the U.S. economy anywhere from $3 billion to $6 billion in lost economic activity. Some sectors were hit harder than others. The federal contractor sector, housing markets near government hubs, and even tourism in Washington, D.C. saw noticeable downturns. But the impact didn't stop at the U.S. borders. Global markets reacted too. Investors in Europe and Asia, already sensitive to U.S. fiscal policy, adjusted their positions. Emerging markets tied to the dollar saw currency fluctuations. Bonds markets became more volatile. Hedge funds repositioned. In short, a political impasse in Washington cascaded across the global financial system. Why does this matter for everyday investors? Because market volatility is contagious. Even if you don't directly own stocks, pensions, 401ks, or investment accounts, you feel the effect in retirement funds, lending rates, and consumer confidence. A shutdown might seem like a political chess game, but the financial consequences are very real. And here's the kicker. It's not just lost revenue or delayed spending. The psychological impact on markets can be long-lasting. Investors hate uncertainty. They don't just react to numbers. They react to fear, doubt, and speculation. When the shutdown dragged on for over a month, confidence wavered and volatility spiked. Trading volumes increased, options markets became jittery, and safe haven assets like gold and treasury bonds saw surges in demand. The question isn't just how much money was lost, it's how deeply a shutdown erodes trust in the system. And the 2018 to 2019 Trump shutdown was a masterclass in illustrating that fragility. It also exposed one of the most critical lessons in economics. Markets hate uncertainty more than they hate bad news. But the story doesn't end with numbers and market swings. There's a deeper structural element at play here, the interplay between politics, fiscal policy, and market psychology. And understanding that is key to predicting how future shutdowns could impact global markets, investor behavior, and even the U.S. economy itself. So, how do markets actually respond when the government shuts down? Let's break it down. The 2018 to 2019 Trump shutdown offers a clear, almost real-time case study. The first reaction was immediate. Uncertainty surged. Investors don't like waiting in the dark. Without clarity on when funding would resume, portfolio managers scrambled, equities dropped. Trading volumes spiked, and even bonds, typically seen as safe, experienced turbulence as the yield curve reflected risk sentiment. One of the first casualties was the federal contractor sector. Companies like Lockheed Martin, Northrop Grumman, and Booz Allen Hamilton rely heavily on government contracts. During the shutdown, payments were delayed, employees were furloughed, project timelines stretched out. The market responded with a predictable logic. Revenue uncertainty translates to lower earnings projections, which in turn pushes stock prices down. In the weeks of the shutdown, analysts estimated that the sector lost billions in market value. Retail and consumer spending also took a hit. Think about it. Nearly 1 million federal employees either weren't getting paid or were working without pay. That translates into delayed mortgages, postponed car purchases, and reduced discretionary spending. Retail giants, restaurants, and service providers near federal hubs felt it immediately. Some local businesses reported a 20 to 30% drop in revenue during the shutdown, and when large consumer-facing companies report weaker than expected earnings, the ripple spreads to investors far beyond Washington. But it wasn't just immediate spending. The shutdown also affected market expectations for GDP growth. Economists initially predicted a temporary drag of $6 billion in GDP for each week the shutdown persisted. That figure alone triggered recalculations across investment banks and fund managers. Futures markets began pricing in lower growth, and volatility indices spiked. Investors started hedging aggressively, moving money into assets perceived as safe havens, gold, U.S. Treasury bonds, and even the Japanese yen. Interestingly, not every investor panicked. Some hedge funds and contrarian investors saw opportunity. When the market dips due to political turmoil, there's always a chance to buy undervalued assets, but this requires nerve. Betting against widespread uncertainty is not for the faint-hearted. Those who played it right were able to capitalize on mispricing caused not by fundamentals, but by fear. Another subtle effect was on interest rates. With uncertainty mounting, the Federal Reserve faced a tricky balancing act. Prolonged shutdowns could slow economic activity, potentially forcing adjustments in monetary policy. Even speculation about such moves can shift bond yields. During Trump's shutdown, short-term Treasury yields fell slightly, reflecting demand for perceived safety, while corporate bonds saw spreads widen as investors demanded more compensation for risk. Let's zoom out for a moment. Why does political stalemate translate so violently into financial consequences? The answer lies in confidence. Markets thrive on predictability and transparent policy. When uncertainty enters the system, it's not the actual loss that causes panic, it's the unknown. How long will the shutdown last? Will government contractors default? Will consumer spending rebound? Each question adds a layer of risk. And risk is costly. Even more fascinating is how this volatility feeds into the psychology of investing. Human behavior amplifies financial movements. Fear is contagious. News headlines highlighting billions lost act as a feedback loop. Traders see a drop, they sell. Others see them selling, they sell too. It's a chain reaction, and this is exactly what happened during the Trump shutdown. Markets weren't just reacting to lost dollars. They were reacting to the fear of lost dollars. The shutdown also illustrated a critical point about sectoral resilience. Some areas of the economy weathered the storm better than others. Tech companies, for instance, had less direct exposure to federal funding and payroll shocks. Financial institutions were influenced more by interest rate speculation than by direct consumer behavior. That's why during the shutdown, you could see divergent movements. Some stocks plummeted, others barely blinked. In Part 3, we'll bring it all together. We'll explore the final tally of losses, the lessons investors and policymakers should learn, and why shutdowns are more than just political theater. They are a clear, measurable threat to market stability. We'll also look at real-world strategies that investors can use to protect themselves in uncertain political climates, and why even in chaos, opportunity can exist. When the dust finally settled after the Trump shutdown, the numbers were striking. Analysts estimated that the U.S. economy lost over $11 billion in total, a combination of reduced federal spending, delayed contracts, and lower consumer activity. Some sectors never fully recovered in the short term, while others rebounded quickly once funding resumed. But beyond the raw dollars, the shutdown left a deeper mark. It exposed how fragile market confidence can be when politics and economics collide. One of the most important lessons here is that markets are not just driven by fundamentals. They are driven by expectations, sentiment, and psychology. A shutdown doesn't only halt government operations, it halts certainty, and uncertainty, more than almost anything else, drives investors to act defensively. Safe haven assets surge, riskier positions are sold off, and volatility spikes. Traders learned the hard way that political theater can have real, costly consequences. Interestingly, some investors saw the shutdown as a buying opportunity. Market dips caused by fear rather than fundamentals often present strategic entry points. Those who stayed rational, assessed the real impact versus the panic, and positioned themselves carefully were able to profit when the market corrected. It's a powerful reminder that even in chaos, there is opportunity, but it requires discipline, research, and patience. The shutdown also highlighted a structural truth about the U.S. economy. It is deeply interconnected with government activity. Federal employees, contractors, consumer confidence, and global investors all form part of a delicate ecosystem. A disruption in one area cascades across multiple sectors, domestic and international. Investors who ignore this interplay do so at their own peril. For policymakers, the Trump shutdown was a cautionary tale. Beyond politics, there are tangible costs to prolonged deadlocks. Businesses suffer, economic growth slows, and trust in government can erode for markets. This translates into real-world losses and increased volatility, sometimes even long after the shutdown ends. So, what can investors take away from all of this? First, always monitor political risk. It matters. Second, diversify across sectors and asset classes to hedge against unexpected shocks. Third, understand that market reactions are often amplified by psychology, not just fundamentals. And finally, remember that volatility can create opportunity if approached strategically. In the end, the Trump shutdown was more than just a political showdown. It was a real-world experiment in how markets respond to uncertainty, how billions can be lost in a matter of weeks, and how fear can ripple faster than facts. It reminded investors and economists alike that money isn't just numbers on a screen. It's deeply connected to human behavior, government policy, and global sentiment. If there's one takeaway, it's this: markets are sensitive, intelligent, and sometimes ruthless, but they also reward those who can remain calm, think critically, and act decisively. The shutdown was messy, expensive, and disruptive, but for those who understood it, it was also a lesson in strategy, patience, and the power of understanding the intersection between politics and economics. If you found this analysis insightful, make sure to like this video, share your thoughts in the comments, and subscribe for more deep dives into the forces shaping our financial world. Don't forget to check out our other videos where we break down market-moving events, economic shocks, and the lessons every investor needs to know. Markets can be unpredictable, but with knowledge, you can stay one step ahead.